Okay. I'm sort of anal retentive about time, so my son's, which drove my son's wild, because he said, 7 o'clock, plus or minus 10 minutes. And I said, no, 7 o'clock, pronto. So this is a McDermond Center lecture, and the reason we are doing these is I met with a bunch of seniors. And I said, what can we do for you? And they said, well, we don't have any practical knowledge. We want to know practical knowledge. So I started with Financial Planning 101. How many of you went to the Financial Planning 101? Only 3 or 4, right? There's no retention. So I did Financial Planning 101, and then this one I'm doing Stock Market 101. Now why am I qualified to talk about the stock market? Probably my dad would ask that question, because well into my 50s he said, when are you going to grow up, right? And so I don't know, I think he'd say, don't listen to this guy. As most of you know, I'm in the econ department. I made my first investment when I was 19 years old. I would not recommend what I did when I was 19. I didn't know what the heck I was doing. So I made and I've been in the stock market ever since. And for me, the stock market's been really good, really good. The last, I just checked on the way over here. The last year was up 30%, right? So if I could just keep doing that, it'll work for me, right? I have some clients I help with investments. I'm going to teach investments next semester. I have written articles about investments. I've been on TV, and sometimes you want to, I'll tell you about my TV experience. Well, I'll just tell you anyway. I had a mic on, and I'm talking, and all of a sudden I feel, I'm sitting down, and I feel it drop into my lap. And all of a sudden I'm talking into my, it's just like, oh, come on. And so the guy literally came out, it was live TV, right? He came out and remiked me, and I go, oh, this is not working anyway. So I've done some radio. So I've seen the stock market, or the investment, from an academic point of view. I've read numerous articles and books about investments and what academics have to say. I do the practical stuff, and I'm a chair of an investment committee where we oversee 85 mutual funds with about $30 billion, $30 to $40 billion under management. And so I get to rub elbows with people who are out in the real world doing these things. So I've seen the world from the practical point of view, people who actually do this for a living. What I'm going to do is I'm going to avoid jargon as much as I possibly can. I'm also, for the first time in my life, I think Mike used to give me a bunch of stuff about this. Economists always on one hand, on the other hand, right? And Harry Truman once said he got tired because he'd bring an economist in and they say, on one hand it's this way, on the other hand it's this way. And he finally just said, don't just send in one-armed economists. I don't want to hear about the other hand. So I'm going to try as much as I possibly can to be a one-handed economist. Because there's always exceptions to the rule, right? But the rules are pretty clear. I will try to avoid jargon. I will try to talk as a one-handed economist. The really sad thing is, what I do for a living is really simple. I don't like to tell people because they go, you got a PhD and that's all you know? And I go, yeah, I'm sorry, but that's the way it is. If anything I say doesn't make sense, either I said it wrong, you didn't hear it right, or it's just wrong, right? The stock market's really just common sense. The stuff can be really complicated, and if any of you are considering taking investments next semester, you go, holy cow. I mean, the mathematics is unbelievable. But what I'm going to tell you is what you need to know. If you follow the advice I'm about to give, you'll beat 95% of the money managers in the world. You'll beat 95% of the people who invest. This is Stock Market 101. What I'm going to do today, I'm actually really bad at figuring out how long things are going to take me. I think what I plan on doing is about 45 minutes today, 40 to 50 minutes. I'll get you out of here, I promise, by 8 o'clock. I'm going to sort of go over the overview, and then next Thursday, I'm going to do the second part, and I'm actually going to grade portfolios. And I'm going to name names, right? One of the things that's always frustrating when you go to a meeting like this, you go, well, that's good, that's good, that's good. How do you do it? And that guy walks out, right? And I don't know how to do it, right? I'm actually going to give you names of things that you should invest in. I'm going to grade portfolios. I'm going to put grades on them like I taught the class and people submitted these portfolios. So the second part is really the grading. Here's what you really should do. Okay, the only thing I asked people to bring me was a clicker so I could advance. Probably the way we should run this is, I gave you the slides and places to write stuff, so if you got questions, probably the best way to do this is to hold your questions to the end and maybe I'll cover them. First thing, this is sort of a repeat of my Financial Planning 101. You should not put money that we consider rainy day money into the stock market. It's just too risky, all right? And I'll show you why in a second. Susan and I, my wife and I, just found out we need a new roof. The last thing I want to do is put a new roof on the house, but and then the furnace guy came by and said, oh, you need a new furnace, right? Oh, man, come on, man. Things like that happen, right? You have a car accident, you have health, who knows, right? You need money and rainy day money, and this is not where the stock market's not where you put rainy day money, because the market may be way down when you go to invest. So do not put rainy day money into the stock market. The other thing is insurance. I would not walk across the street without health insurance because I might end up in Hendricks and the CEO there makes a hell of a lot of money. And so I thought somebody was coming in. You need insurance, right? And insurance is for catastrophic losses with low probability. Did you guys go to the wrong room? Yeah. Sorry about that. There's a note there. We just started, so I gave them all the truth and what they really need to know, but that's all right. You guys. Catastrophic losses, things you can't afford, right? With a very low probability. If you have catastrophic losses with high probability, you can't afford the insurance. You need to find something else to do, right? You know, things like car insurance, right? I have $1 million. I have $1 million umbrella policy, right, on my car. What do you think the last $1 million cost me a year? $130. I have earth movement insurance. If my house goes down and I'm not insured, and if it's an earthquake, I'm not insured, right? You got to have a rider for earth movement insurance. My house, I'm wiped out. It costs me $20 a year to have earth movement insurance. And the earth is going to move in Greencastle, right? The biggest earthquake ever was down in southeast Missouri, and it rang bells in Boston when it happened. So it's going to happen. Now, maybe not in my, soon, i.e. sometime in the next 500 years, right? I may be gone, but for 20 bucks. So, you know, this is what I call warm-up exercises. These are things you should do. Long run versus short run. Those of you who are econ majors, pop quiz. What's the difference between long run and short run? Ah, come on, man. What's a short run? What does an economist define as short run? something's fixed, right? There's at least one fixed input. If I'm CEO of General Motors and I'm thinking about how many cars I produce in 6 months, it's a short-run decision because the plant size is fixed. You know, I can add labor, I can second shift, third shift, but it's a short-run decision because one of the inputs are fixed. In the long run, everything's variable. So if I'm the CEO of General Motors and I'm thinking about how many cars to make 10 years from now, I can think about what size is the appropriate plants, where I put the plants. Okay, here's my first thing. My one hand economist. Actually, one of my favorite sayings is, Keynes once said, you know, people ask economists, what's the difference between the short run and the long run? And Keynes once said, the difference between the short run and the long run, in the long run we're all dead. Right? So everything's variable, even okay, here goes. I got my one hand tied. If you want to know, if you want a number, here's what I'm going to do. It's 5 years. If you're thinking about putting the money in the stock market, 5 years is usually what I would consider the minimum time. And I'll tell you why in a second. But so if you're thinking about buying a car 2 years from now, probably the stock market is not where you should be. You know, if you're going to send your daughter to DePauw in 3 years, not the stock market. So now, is that an absolute rule? The answer is no. But 5 years. 5 years. It's sort of the minimum time to consider if you're going to put the money in the stock market. And here's why. Here's the numbers. If you buy stock on the beginning of the year and you sold at the end of the year, all right, and you look at the last 50 years, the best year you make 53%. Ka-ching! Pretty damn good, right? 53% a year? I can live with that. The bad news is you could have lost 26%. Okay? If, on the other hand, you bought on January 1st and sold on December 31st, 5 years, best year, 29, or best 5-year period, 29, the worst is 2.4. I mean, I don't want to lose 2.4 over 5 years, but you see what's happening, right? The top numbers are coming down, the bottom numbers are coming up. So the risk is taken out. So, you know, why 5 years? Why not 10? Why not 8? Why not 4? Whatever. But, you know, 5 years is what I consider the minimum. And, you know, when I think about it, I think about this chart, right? I mean, I told you the last year has been wonderful. 30%. I can live with that. I also lost 30% in 2008, right? And so if I put in January 1st and got out on December 31st, it wouldn't have been so much fun. So what are we going to do? Here's what we're going to do. There are 3 ways to look at the stock market. I'm going to tell you how to look at the stock market. 3 different ways. So that's the first thing we're going to do. The second thing is there are 2 things. There are 2 slides here that are important. You can sleep through the rest of this. There are 2 slides that are important. The rest of it is but there are 2 slides that are important. And so I will cue you. I'll try to wake you up when I get to those slides so you'll know what they are. And then I'm going to, this is today, and this is a week from today. And I promise you a week from today I'm going to name names. Here's what you should invest in. I'm going to tell you what you shouldn't do, what you should do, what's okay. So I'm going to get probably 7 or 8 portfolios. I'm going to assign grades. Guess who's going to get the A? My portfolio, right? So I'll show you what I do. I'm going to show you what not to do. Okay, I got to give you my favorite stock quotes. October. Damn bad month to invest. October 29 was one of the worst months ever. I think the market was down 20-25%. I think 2007 it was down about that much. And there was another one. There are 3 Octobers in the last 90 years. It's just been horrible. What are the others? Oh, July, January, September, April, November, May, March, June, December, August, and February. Mark Twain. How many months are up there? 12. What's the takeaway? I mean, it's funny. I like it. I read it and I said, oh, I like that. Enough, so I typed it up. Why do I like it? Something you need to remember. The stock market's risky. I don't care what month you do, right? The stock market's risky. Which months are risky? Just 12 of them, right? The rest of them are not so bad, but those 12. The next one is Will Rogers. I paraphrase this one. You know, the stock market's really easy. What you do is you buy a stock, you wait a while, it goes up, and then you sell it. If it didn't go up, don't buy it. Right? What else can you say? That's Will Rogers' take. This next one is Paul Samuelson. People my age, did you guys take econ in high school or college? Did you use Samuelson? Samuelson was the textbook. I took my intro to econ using Paul Samuelson. The last time I taught intro to econ, I used Samuelson. It's not as popular. Samuelson is now dead. He won the Nobel Prize in economics. He could be a little crusty at times. And he wrote an op-ed piece in 1974. And I just quoted some of the things in this. He said that investment managers should drop dead. So he also said at the very least they should go out of business. They should take up plumbing, and my favorite one is, or teach Greek. Do something productive, right? Anything productive. And then the last one, work for a corporation, one that produces something useful, i.e. money managers really are useless. He actually started something that I'm going to talk a lot about. I mean, he wrote this in 1974, and in 1976, a guy named John Bogle started a company called Vanguard, which you'll hear me talk about a lot. And so this really, did it win him any big supporters on Wall Street? Not so much, right? I mean, you tell me to drop dead and I'm worthless and I really should teach Greek, and I go, maybe not so much, right? This is the way I make my living. Okay, this is one of the slides. There are 2 rules to investing in the stock market. Actually, I thought these are mine, but I actually found them somewhere, so I didn't quote these, but I may have be dealing in plagiarism here. I thought I came up with it. 2 rules to the stock market. Okay? Rule number 1, buy low, sell high. Rule number 2, don't forget rule number 1. Now, if I were sitting here right now, I swear, if I were sitting here, where the hell's the exit? This guy's got a PhD, and he just told me to buy low, sell high. Are you kidding me? Are you kidding me? This is one of the most important slides I'm going to put up. Buy low, sell high. What the hell? I mean, jeez, come on, man. Most people on Wall Street violate this rule. Are you kidding me? No, I'm not. Now, once again, if I were doing this in a professional setting, I would not put these numbers up. These are sort of gross numbers. On average, the stock market's up 10% a year. On average, right? Some years 50, some years down 30. On average, over long periods of time, you could expect to make 10% a year. Which means you double your money every 7 years. All right? The next thing says the average investor earns 7% per year. market's up 10. Why is the average investor only getting 7? Where's that 3% going? Anybody want to venture a guess?
Taxes?
Sorry?
Taxes?
No, as it turns out we're doing before taxes, but good. There's no free lunch. Eventually you have to pay taxes, but that's not where the slippage is.
Bankers.
Buying not very low and selling not very high.
Yeah, right. I mean, right, that's, actually somebody said money managers. In general, money managers take 1%. And I'm going to talk about that in a little bit. By the way, this is the only technical thing I'm going to, well, this is one of the few technical things, basis points, which I misspelled. My wife pointed it out to me in the back. So let's talk dirty. So let's talk basis points. 100 basis points equal 1%. So if I say 50 basis points, a half of 1%. 30 basis points, 3/10 of 1%. 150 basis points, 1.5%. Okay? So in general, money managers charge 100 basis points, 1%. It's gone. You didn't get it, right? So we're at 10 and 9. By the way, and some charge as much as 200 basis points, 2%. I was just at a conference, an investment fund conference. The guy charges 150 basis points, which is, in my opinion, highway robbery. However, I went, right, and they have people come in, they talk about, it's sort of interesting. We go to lunch, right? We have a great box lunch. There's, it's named, and on the program it says surprise entertainment. It's Melissa Etheridge. It comes out, I go, holy cow. So we go back to the conference, and then they have surprise entertainment at the end. It's Barbara Streisand. Barbara Streisand doesn't do anything, right? She came out, she actually told a joke. This guy is one of the 400 richest guys in the world. He's writing billions of money because he charges 150 basis points to do a money manager. And she said, he paid me a lot of money to do this. I would guess this conference cost this guy $750,000. Right? It's just unbelievable. So the other 2%, okay, so 1% if you're lucky, if you get this guy, it's going to be 150, 200 basis points. Where's the other 2% go? Somebody said, you violate rule number 1. Why the hell do people buy high and sell low? How do they do it? How do they do it? Why do they do it? Okay, 2007 was a bad year. Stock market down 10%. Now what did I do? If it was a bargain before, what did I do? I bought more. Down another 10%. Oh, now I'm down 20%. What's that rule again? I bought more. Down 30%. Oh my God. Why am I doing this? I bought more. But what did most people do? Sold. So they sold low, and then the market shot back up, and what did they do? They bought back in. They lost 34% and said, oh my God, I can't do this, I can't do this. Ah! The market shot back up and they bought in. What did they do? They violated rule number 1. They sold low and bought high. And on average, people lose around 2% more. The average investor. Now it's easy for me to say, and I'll have to admit, when I was buying and it was down 30% and GM was going and there was a financial crisis, come on in, man. Come on in there. Your wife's up front.
She can stay in the front. I'll sit in the back.
You gotta sit next to my wife. I don't know about that. Shoot that back there. It's easier said than done, right? I mean, people just said, I can't stand, you know, this is the second time, I never quote Harry Truman. You know, Harry Truman said, if you can't stand the heat, get out of the kitchen. You shouldn't have been in the stock market, right? When it's going down, it's a natural tendency, get out. Oh my God. I mean, there was a financial crisis, GM went bankrupt, it was pretty tense. It was not clear to me even that we were going to survive. But I kept jumping in more and more and more. So I was buying low, was selling high. Well, and you know, most people look at me because they know I do things in the stock market, and the market's down, and they say, aren't you depressed? Well, because I'm not a seller. I'm a buyer. I'm still accumulating, although maybe. Now when I sell, damn it better be high, right? I mean, I've been buying low. But when you're accumulating, you want the market to be down. You should go, ka-ching, it's down 30%, ka-ching, right? Go for it, another 20%, right? You know, I do this one for fun, because I try to, but people violate this. I mean, it seems like it's just one of the rules that you should not violate. Uh-oh. Technical analysis. I'll do this one fast. Technical analysis. These are people who look at charts, right? Why might it work? History may repeat itself. What you're going to do, what you try to do in technical analysis is you try to look for patterns. You look for patterns in the stock market and you say, okay, I know in the past when it does these kinds of things, when it's up this much, and I've been doing that, and then I know it's going to be up. Right? So it's technical analysis, it's charting. You look for patterns, which will give you insight in what stocks to buy. You don't even need to know the company. You don't need to know anything of the finances. A real technical person says, all I need is the charts. It tells me everything I need to know. So whether it's General Motors or fly-by-night, I don't care. Give me the charts. Why it might not work. The stock market's a random walk. I was a math major. There's a technical definition of random walk, but here's what a random walk is. I'm drunk. Okay, you know where I've been. Tell me where I'm going. You have no idea. I may fall flat on my face. That's what a random walk is. The stock market's a random walk. You know where the market was. You know what it's done. It doesn't give you any insight to where it's going. And believe me, this is one of these things, once again, I'll be a one-handed economist. Technical analysis just doesn't work. If somebody says, I know where the stock market's going to go, say, thanks for telling me, and then turn around and run away. It doesn't make any sense, right? And you know, the proof for me is, let's assume I did know. And I get to be on The Daily Show, Jon Stewart, Stephen Colbert. I'm on NBC News. I'm on the front page of the Wall Street Journal. Gary Lemon is brilliant. He knows where the market's going. And so I tweet that GM is going to go up. It's at 20 now, and it's going to go to 40 a week from today. What's going to happen? It's going up now 40, right? Right? Everybody's going to. So if technical analysis works, you've got to have monopoly information, right? Nobody else can know this pattern. And believe me, computers have gone through data, right? There are a lot of people who need PhDs, need to get promoted, have looked for patterns, right? Computers will crunch through numbers forever. It's a random walk. You know where it's been, but you have no idea where it works. So, technical analysis, forget it. Except I got a footnote. I couldn't get I left my arm up. I'm a contrarian. When everyone's running for the exit, I'm running in, and when everyone, running again. When everyone's running for the exit, I'm running in, and vice versa. Right? When everyone's running in, I'm running out. Right? There's some momentum, but it ain't going to get you rich. And so, if you don't want to, but you got to be a contrarian. You can't go with the crowd. The crowd will never get you. It'll get you in trouble. So, I don't believe technical analysis works, but if you're going to do something like that, if you're going to try to time the market, be a contrarian. Do exactly the opposite of what a well analysis is. Okay, in my stock market course, I'm teaching investment. This is where we'll spend the bulk of the time. This is what most people who do investment analysis, this is what they do. They do fundamental analysis. And I, once again, I'll throw out a little bit. Some of you don't know this. If I buy I'm going to use General Electric. I used to work at General Electric. I'm going to buy General Electric. I'm going to buy 1% of General Electric. What does that mean? That means I get 1% of their profits forever. And what I want to do is figure out what that is worth today. So what economists call, I want to discount the future flows of profits back to the present. So if GE is selling for $20 and I discount the present value of those cash flows and it's worth 40, it's undervalued. So you'll hear analysts say, oh, it's undervalued, you should buy it. So, so you do the discounted present value of all future cash flows. There's only one problem with this. Did anybody pick up the problem? How did I get $40? All I had to do was predict the future forever. I said I wanted to discount present value of all future cash flows, which means I've got to predict next year, the year after that, the year after that, the year after that, the year after... I got to predict the future. Now, I worked at General Electric. I worked in a fairly small department. There were 127 departments. We had no idea what next month was going to be. And right, we worked there. I was the green eye shade guy, right? I worked there. We didn't know what profit's going to be next month, let alone next year. And now you're an analyst. The other thing you got to do is you got to figure out the appropriate discount rate. And that's not easy either. We'll probably in that class spend a week talking about discount rates. What are the, I'm not a week, a day. What's a proper discount rate? So I mean, it's a wonderful formula I could write up there. And I'm a mathematician. I look at, man, that's airtight. Except the only thing you have to do is predict the future. That's all. Now, I told you we have 80 mutual funds. We probably have 250 portfolio managers managing that money. And they have analysts. We probably have over 1,000 people looking for stocks. There are tens of thousands of people, right? If you took the whole market, there are tens of, and let's see, I'm sitting here and I'm going to figure out better the future than anybody else, right? You know, if you think GE is undervalued, why aren't these other idiots buying it, right? I just said, you know, I think it's worth 40 and selling for 20. These other people with millions of dollars and hundreds of hours of research, why aren't they ticking the price up? Maybe I don't know how to do the discounting, correct? Or maybe I don't know how to do the future. If you're going to do this, and these men and women are brilliant, right? I tell you, I work with them. These men and women are brilliant, they work hard. But if you're going to beat the market, you're going to have to be better than them. You can't be just as good as they are. You got to be better than they are. Okay, this is probably, help me. Pass those out. I need everybody to take a penny. You're getting paid to listen to me. And I'm giving you exactly what it's worth, all right? So everybody get a penny. Pass them around. And I don't want these back. Pass out pennies. Pass them out.
Someone's concerned about the retirement fund.
Yeah. Does everybody have a penny? We need some pennies over here. Come on, I know there's more than... don't hoard the pennies, guys. Where's extra pennies? Yeah. I just said not take more than one. Come on. Okay, everybody stand up. Okay, everybody got a penny, right? I want you to flip it, put it down. Don't look at it yet. Put it down. Some of you are really loud. Heads are winners, tails are losers. Everybody's got a tail. Sit down, you're losers. I don't even want to talk to you anymore. Sit down, losers. Tails are losers, heads are winners. Okay, God, Martin, you sit down. You only half of you're supposed to. Okay, flip again. Heads are winners, tails are losers. Sit down, losers. Sit down. All right. No cheating. All right, let me hear it. Okay, flip again. Heads are winners, tails are losers. Sit down, losers. Okay, flip it again. Heads are winners, tails are losers. Sit down, losers. Okay, my name is Gary Lemon. I'm at NBC News. I hear you are the greatest tail flipper in the world. Can you tell me how you flip coins? Do you actually see it as you're turning so you'll know what it is? I mean, you're really good at this. I can't believe how good you are. I'm with you, man.
All right.
It's really good. I'm really impressed. Flip it again.
Shit. I dropped my what? Never mind. That's still good.
No cheating. Oh, you're still up? Oh, God, I'm sorry.
I started late.
Oh, you started late. Flip again. Another head. This guy, are you another head? These guys are really good. I'm putting all my money with them.
Now you know why you married her.
Yeah, right. Flip again. Flip again. How many times have you done it?
6 seconds.
Tails.
Sit down, loser. Yeah, everybody. Now, why did I do that? Okay, we got literally probably 8,000 to 10,000 mutual funds out there. Half of them are going to be winners and half of them are going to be losers. If we had 10,000 people in this, right, somebody's going to flip ahead 8, 9, 10 times, and you're going to say, oh my God, you're good, right? You manage money and you beat the market 10 times in a row. Don't you want to put your money with them? I mean, what the hell? I mean, you can pick up the Wall Street Journal. These people will be listed. They'll be on the cover of Money magazine. Well, these people are so deep. Over 10 years, they beat the market. Well, there are 2 explanations. Number one, what are the 2 explanations?
They're lucky.
They're lucky, or they're good. They're lucky or they're good. The problem is, I don't know which. I don't know which. Right? Somebody's going to, and so, half the people are going to beat the market, half the people are going to lose, and somebody's going to do it 8 or 9 times in a row. Now, it could be because they're damn good. However, there's a lot of evidence. If you took the mutual funds, right, professional money managers, and you took the top quartile and you took the bottom quartile, which one do you think you should, if you were forced to invest, which one do you think you should invest in? The lower quartile. There's something called regression to the mean, right? On average, they're going to be average. So you may flip 8 coins in a row, but if you do it 100 times, you're going to be around 50, right? So there's a regression to the mean. So it's literally worthless information looking at mutual funds and saying, now, there may be somebody out there named Warren Buffett, but the problem is by the time you figure out who Warren Buffett is, he's probably too large, and he can't do what he used to do, or he's closed the fund, you can't even get in, and I don't know who they are, and nobody else does either. So, think about flipping the coin. Regression to the mean. How do you differentiate lucky from the good? This is the problem with fundamental analysis. Remember, if you're buying a stock, remember, there are big boys and big girls out there with millions of dollars spending all their life trying to find these stocks. And you found something they didn't? Consistently? If you do, come see me, right? Because I want to be rich. But they're not out there. They're not out there, I'm sorry. Wait a second, that's just what I did. Deja vu. Okay, here's how academics view the world. Oh, by the way, I know why.
Okay, sorry.
Yeah, right. Yeah, I got a footnote. Oh, there's my second hand coming up again. I believe the market, 98% of the market's efficient, right? I told you I wasn't going to do this, but I got to. I believe there are pockets of inefficiency. All right? I think most stocks, the odds of General Motors not being fairly priced are virtually zero. General Electric, you know, there are too many people watching it. You might beat it sometimes, but sometimes you're going to lose to it. So, okay, I've never used this analogy, and it's probably terrible. But you know, if I used to play basketball. Right? When I was in high school, I was a basketball. And so, here are the Miami Heat or the Indiana Pacers. Hey, let's play a pickup game. I think I'm still good. Right? I probably couldn't get the ball out of bounds, right? I mean, oh man. I'm going to take my ball and go somewhere else. I'm going to go to the third graders. I think I can play with third graders, right? If you're going to play the stock market game, don't play with the Heat or the Pacers. Play with where they can't go, and where they can't go is small cap stocks. Stocks that are small, right? Not much. It's just too small. They can't get in and get out. They got too much money to do. So if you're going to do the stock market, my footnote is small cap stocks. Go where the big boys and big girls don't go. They can't get in because they got too much money to move. This is your advantage. So if you're going to do it, there are pockets of inefficiency, but it's going to take a lot of work. You're not going to get rich quick, but if you're going to do it, go to where the small stocks are, or sometimes they're called neglected stocks. A lot of different terms. Okay, efficient markets. This is what I'll teach in investments. This is what the academic community talks about. All stocks are fairly priced. The reason GE is at $20 is because that's what it deserves to be at. All stocks. And so literally they used to, and they don't do this anymore because too many people lost, they would literally get monkeys, put the Wall Street Journal, all the stocks, and they'd have monkeys throw 10 darts, and then they go to a professional money manager and say, okay, beat the monkeys. And guess what? How many times do you think the monkeys win? About half the time. And the pickers. And so all of a sudden, do you want to play this game? Going against some monkey throwing a dart. And so they couldn't get any more money managers to do it, right? Because half the time the monkeys won. So most economists, people who look at these things, all stocks are fairly priced. All public information is reflected in the stock price, right? Because, in some sense, this is a free rider problem. I teach public finance too, and there's things called free riders. I don't have to work because everyone else is working really hard, right? Everyone else is making decisions and buying and selling and looking at General Motors. I don't have to because I know it's fairly priced because everyone else is looking. So it's one of these things that, man, I'm glad they work hard. I don't have to because I know it's all fairly priced. If you can't beat them, join them. All right? If you can't beat the average, what the hell? I'll just try to do the average. And when Samuelson wrote that scathing editorial, what he was arguing for is index funds. And guess what an index fund does? It just tries to match the index. I can't beat them, I'm going to join them. So index funds are what you do if you believe the efficient markets, and most of the research shows that the markets are efficient. People who don't have anything to sell, right, except advice, says that index funds are the way to go. And so, guess when I grade the portfolios, I'll show you index funds. I got a footnote again. What does it say? Dimensions. It should be actually dimensional, not dimensions. What's the name of the University of Chicago School of Business? Does anybody know? Booth. Why is it called the Booth School of Business?
Last name?
Last name, I mean, why did they pick Booth? Random? 300 million. 300 million. For 300 million, you get your name slapped onto a very good school of business. Now, I got to tell you, Booth did his graduate work at the University of Chicago. Where did he do his undergraduate work? The University of Kansas. So it turns out he's 1 year older than I, so we had to be in the same building, right? We may have even taken the same courses, right? If you have watched the Sports Center's 30 Under 30, he is featured in one of them. He bought the University, by the way, if you go to the University of Kansas, in front of the field house where they play basketball, it's called the Booth Athletic Hall of Fame. Same guy, right? He actually grew up on Naismith Drive in Lawrence, Kansas. He hasn't given $300 million to the University of Kansas, but he did build the Hall of Fame, which sits in front of the, and he also bought James Naismith, right, the father of basketball. He handwrote the rules of basketball, and he bought them, I think, for $8 million and gave them to the University of Kansas. Booth went to the University of Chicago, and he took investments, and the people up there said, here's how you beat the market. And he said, you guys talk this mean game, maybe I should do it. And so he started a firm called Dimensional Funds, and obviously been very successful. If you can give away $300 million, he probably didn't give away his last cent, so he's got even more money. I actually heard him talk, and somebody said, why the hell would you give Chicago $300 million? Why that? And he said, look, when I was at the University of Chicago, someone said, look, here's your life. We're going to teach you how to do this, and all you got to do is give us $300 million. He said, I would have signed the contract instantly, right? He said, you know, these people told me how to invest, and what his firm does, there are certain things that he says works, and this is counter to the efficient markets. What are the things that work? Number one, small stocks, and what I call contrarian investments, i.e. what you want to buy is stocks that are out of favor. What are sometimes referred to as value stocks, right? There are growth stocks and there are value stocks, and these are the ones out of favor. Nobody wants them. They're dogs. I don't want to buy that stock. Why would you want to be in that stock? I told you I listened to professional men and women talk about portfolios. And we had these brilliant people come in, and every one of them said, Apple. We're buying Apple. God, do we love Apple? Apple, 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 Apple. I'm sitting to the guy next to me, and guess what I said? I'm shorting Apple today. And when you short something, all you want to go down, right? If everyone's buying Apple, right, you're out. And so people are paying high prices to get Apple. And that's exactly when you want to get out of Apple, right? So we'll see. I did not short Apple. But anyway, I believe in efficient markets. Dimensional is probably, we have some money, Susan, at Dimensional, so we're making Booth even richer. Okay, I told you there are two slides. This is the second one. The first one is don't buy low, sell high. Did I say that right? Buy low, yes, I did. I thought I said it wrong. It sounds funny, but it's true. There's only two things you can control when you're in the stock market. Only two. Rest of it, forget. Right? I mean, you can't influence inflation, monetary policy, fiscal policy, what's going on in the Mideast. I mean, these things are beyond your control. Right? Focus on two things. The two things you can control. Everything else is beyond your control. These are it. This is the important slide, the second important slide. Oh, I gotta keep going. The cost you pay for investment advice. Guess what? You want to pay a lot or a little? Everything else equal, economist's favorite phrase, right? Pay low. And I'll show you in another slide, you can get really, really, really good stuff at a really, really, really cheap price. And the second thing is risk. How much risk are you willing to take? You can control risk. You can control costs. Everything else is beyond your control. So focus on those two things. And this is the slide. This is the second slide. In general, you get what you pay for, right? If you pay more for a car, you usually get a better car, better clothes, higher prices, right? In general. This is not true in the stock market. It's not true in the stock market. Some of the worst investors are also some of the highest cost investors. I told you, in general, they'll tell you, I'm a financial planner, right? You come and say, how much are you going to charge me? I'm saying 1% of everything you've got invested. So if I got 100,000, usually they want you to have 500,000, they won't even talk to you, but I can do the math in my head if it's 100,000. So they're going to charge me $1,000 a year. 1%. Doesn't sound too bad, does it? If you do me good. That's one way of looking at it, and that's the way they will present it to you. How much on average are you going to make? What did I say in one of the first slides? 10%, right? Well, 7%. Right, but let's say gross. Gross, I'm going to make 10%. Wait a second, you're taking 1% of my 10%? All of a sudden, that's 10% of what I make. I thought you charged me 1%. Wait a second. I can have a bare-ass monkey throwing darts, and it's going to make 10%, and you're going to charge me 1%. What if you're really, really good, and you make 11% for me? How much did you charge me? 100%, right? You made 11% for me. I could have gotten a bare-ass monkey to give me 10%. So you made 1% more, and you charged me 1%. It's 100%. You see the arithmetic I'm doing? And you really have to be good to do that. You really have to be good to get 1% more. And if I make only 0.5% more for you, right? The bare-ass monkey makes 10, you give me 10.5, you charge me 200% of everything I made. So I've got up there, financial advisor fees charge 1% of the total assets under management. I go, really? No. Even if they make 12%, which would be really tough, risk adjusted, that'd be 50% of everything I make. So a little truth in advertising. That should, I just checked, the most I pay is 25 basis points. I have some stuff that only charges 6 basis points. So, pop quiz. If I have $100,000 and somebody charges me 6 basis points to do it, how much are they charging me in dollars? What's 0.06% of 1% of $100,000? How much are they charging me for each 100,000? Somebody said it.
6 cents.
No, $60. For $100,000, they're charging me $60. I really feel guilty. You should charge me more, but no, I'll take it. 25 is as high as I'll pay. And the question is, why are you paying more than I get really, really, really good service with 6 to 25. This is the next to last slide, and then we're out of here. And that's pretty good for me. Risk is the second thing, right? Some of you have taken Econ, Amy, well, some of you I know have taken Econ 350, right? Taken Econ 350 statistics. We do regression analysis. There's an alpha and there's a beta. And this is all this is the beta they're talking about. And all it is a measure of risk. Now, if this, once again, if I were a two-headed economist, we'd probably spend 2 hours talking about beta. All you need to know is a beta 1 is the average risk of the market. So if I say my portfolio has a beta of 1, I've got market risk. If I've got a beta of 1.2, I got 20% more. So if the market's up 10%, I should make 12%. If the market's down 10%, I should lose 12%. If I got a beta of a half, the market's up 10%, I should get 5%. If the market's down 10%, I should only lose 5%. That's all there is to it. And so one of the measures of risk is beta. This is important. Dollar cost averaging. If I take $1,000 and the stock is selling for 10, I buy 100 shares. You with me? $1,000, $10 a share, I've got 100 shares. The next month, the stock falls to $5 a share. I take the same $1,000, I buy 200 shares, right? So I now have 300 shares and I've got $2,000 invested. You with me? What's my average cost? $10, $5? Sounds like $7.50 to me, right? No. No is the correct answer. What's my average cost? $6.67. $6.60. Whoa! I got a headache. Why is it not $7.50? It's because you bought more shares, right? If you bought the same number of shares, it'd be, but you bought 200 shares rather than 100. And so, what you want to do is you want to put in the same dollar amount. Once again, buy low, sell high, buy low, sell high. And so when the market's going down, you're going to buy more shares with the same amount of money. And you're going to end up with a lower average cost than if you just took the prices. Buy low, sell high, buy low, sell high, buy low, sell high. Okay? Dollar cost averaging is wonderful. I mean, the first time you see it, whoa, that's wrong. No, it's right. Your average cost will be less than $7.50 for the two prices. Diversity, diversify your portfolio, diversify your portfolio, diversify your portfolio. When I go to grade portfolios next time, you'll see I'll give much higher grades to diversity. And the last thing I'll say, I think this is the last slide. Is this next to last slide, right? Yeah. Rebalance. Okay, let me just take a simple example. Let's say I decide that my risk portfolio is I want 80% stocks, 20% bonds. Okay? That's what I think is right for me. Stock market shoots up. Bonds stay constant. I now have 90% in the stock market. What should I do? Buy low, sell high. Buy low, sell high. Buy low, sell high. What should I do to the stocks?
Sell.
Sell. Get it back down to 80%. Buy the bonds that are not moving. Buy low, sell high. Buy low, sell high. Buy low. Right? When you rebalance, what it forces you to do. And you go, my God, wait a second, the stock market is making me so much money. What could I do? Jesus. Sell it. Right? Buy low, sell. And the reverse is true. The market's down, right? I'm 70-30 now rather than 80-20. What should I do? Sell bonds, buy stock. I mean, and of course the way I rebalance, I don't sell, right? Because there are tax implications for selling. What I do is, when I'm buying, I buy the things that are not moving, right? So, I keep the 80-20, but I don't sell the stock. I buy bonds, right? So I get the balance back in. So, how often you rebalance? Look, if it's 81-19, you don't need to rebalance. But if it gets out of whack too far, so in summary, this is it. No mas. Markets are efficient. I really do believe 98% of the markets are efficient. You'll bang your head against the market, or bang your head against the wall trying to find undervalued stocks. Sometimes you'll win. Half the time you'll win, half the time you'll lose. And you wasted a lot of effort and didn't get anywhere. The mantra for the day? Buy low, sell high. And it seems silly, but people lose 2%. On average, people lose 2%. Keep your costs low. And I will talk about Vanguard. Vanguard's my thing, right? Vanguard's, and it's also the lowest cost. Manage your risk, and the correct answer is index funds. So when I do grading of portfolios next time, index funds are going to win. There are good index funds and there are bad index funds. There's an article in, I think yesterday's Wall Street Journal. There's something called smart indexing now. I actually must be doing dumb indexing. The smart indexing just doesn't make any sense. Everyone's trying to invent a new wheel, but believe me, they're not. Okay, I will take 2 questions and then I'll dismiss you, and then if you got other questions, come up and see me and come back. Next Thursday, same time, same Bath station. Huh? Oh, wait a second, stop. There's no free lunch. For 1 penny, I need for you to fill out a survey. If you gotta go, go. Pass these out. It's not a long survey, and don't write, you need to write your name. But, yeah.
You talk about fair price stock. How does a company like Facebook come out?
The evidence is, well, number one, if you got millions of dollars, right, you can get in on the initial public offering. I mean, Gary Lippman never can get in on the initial public offering. They're talking about Facebook, right? I wouldn't touch any IPO with your money, not with my money. It's a loser's game, the people who are going to make the money are the people that have big bucks that they'll let in at the very beginning. And the rest of us, I don't know, I didn't even watch Facebook. Was Facebook the one that crashed? Or was it Twitter the one that did really well? I don't even watch these things. I mean, I'm not going to be asked to do it.
But how do they get a fair market value out of something?
Well, they go to Goldman Sachs, for example, and they say, Goldman, what can you sell this for? And Goldman will say, well, I think we can get it out at $30 a share. So they get experts that do this, and sometimes they're right, sometimes they're wrong. Quite frankly, the ones that jump, was it Twitter that just came out and jumped dramatically the next, I'd be pissed off. If I was the owner of that, I say, why didn't we get $40 a share? Why you sold it at 20, and all of a sudden it's up at 40? I just golden, right? It's not a game I want to play, so don't do it. All right, go away. I hope you enjoyed it. Give Rebecca, if you would, please, the surveys.